Hey guys, I wanted to put together a fund operating profit analysis to try to figure out, how big of a fund folks need, what your expenses are going to be, and kind of what the recurring revenue is going to be. So we're eventually going to get down to operating income by year that you're running the fund, and that's going to tell us whether or not the assumptions and the fees that we're charging are enough to sustain our operations. So I put together this really quickly. I'm sure there's other ways to do it, but limitations of this model, I'll just go through those really quickly. This assumes you're going to place 50% of your equity in year one and then the rest in year two. All your dispositions are going to occur in the same end year. It doesn't matter if it's 3, 4, 5, but you're going to get those fees in the end year and you're going to sell all your assets in the same year. The only recurring fund revenue is net asset value or the management fee. And this is based on net asset value. If we have other ideas on how to create recurring revenue for the fund, I'll put them in here. But this is just assuming one way right now for simplicity. We get amortization benefit through loan payoffs. That's not factored in here, unfortunately, because this is just supposed to be really quick and dirty. And then the last thing, your acquisitions are going to be operating. They're capable of paying for operations on a standalone basis. So you're not going to need to put any additional capital into or equity from your fund into those to kind of steady operations. So this kind of is like not quite like a value add, but more of like a go forward, fund analysis. All right, so I'm going to use Michael as an example. Any rule of thumb, anywhere there is yellow, you can change it. All right, so any of these can be changed, right? So Michael has a $2.5 million fund. He might do 6 transactions, or he might do 4. So let's put 4 here. All right. So if he's only going to do 4, this is all going to change down here. If he's going to do 5, it'll add another one down here for him. 6. All right. Let's run it at 6. Equity. This is your leverage on the asset. So if Michael puts in $420,000, he's going to be able to buy an asset that's 1.2 million. Total across this entire fund, he's going to be able to acquire assets worth 7.2 or 7.1 million. If you change your equity leverage, it's like 30, then this number is going to change as well. It can get up depending on the market, it's going to get higher. But kind of where we're at right now, I would say, based on where rates are and, how banks are operating, I would think, you probably want to stay in the 30 to 35% range. You're not getting 20% anymore, unless you're working with a small bank, maybe. All right, so then this fund is going to target 20%. This really only changes the net asset value calculation, and then I have kind of off spreadsheet calculations here. This is basically calculating the asset value on a per asset basis by year, and this is calculating profit. You don't have to worry about those; those are going to calculate it on its own. So really, this is really only going to change a few things in the model. It's not the big of a deal. It's more of like a check in here. And then the fund term, how long do you want to run your funds? Let's run this one 5 years. You can run it 3, you can run it 2. I wouldn't probably run it anything less than 3. But for Michael's example, let's run it at 4. Okay, so we have that all kind of set up here. The one-time fees that you're going to see are debt placement. So you can change these. Let's say your fund is going to have 1.5 debt placement. Or it's going to have, or it's going to have 3. Your acquisition fees might be, sorry, I thought I was here. your acquisition fees might be 2%. They might be 1%. You can toggle all of that in these cells here. Try to zoom in for you a little bit. And then the disposition, what are you going to charge when you sell the asset? So these are all one-time fees. You can make them whatever you want. Maybe 2%, debt placement, 2%. All right, so anyways, you can change all of those. And then this is your net asset value, management fee or the go-forward management fee. 2% is pretty standard. Actually, I don't know. Put in whatever you want. Could be 3, could be 4, could be 5, could be 1. I'm going to leave 2 in here. So all of this is going to calculate on its own for you. What the one-time fees mean are these aren't recurring, right? So if you place debt on $420,000 in equity, you place $775,000 on it, you're only going to get paid on this one time, right? If you acquire an asset, you're only going to get paid on that one time. If you sell that asset, and this is assuming whatever the asset value is in year 1, then you're only going to get paid at that time. I'll change this up. So this is going to calculate based off of the year that you sell the asset. So if you're selling it in 5 years, this is the asset value in 5 years is what this fee is going to be capped off of. All right, so just assume that all of this is going to run correctly and smoothly, and you're okay with these assumptions of debt, acquisition, disposition, and management fee. You have, your equity to loan value to toggle. You can change the number of transactions. You can change your fund size. You can change your term. All right, so here, this first line is going to be our recurring revenue. So we have recurring revenue per year and the first year is half because we're not going to be able to get all the transactions done at the same time. That's just a general assumption I made. But based on the net asset value here, these are going to be the recurring per year. So Michael's fund might make 75,000 in recurring fees, 165, 177, 190. And sorry, Michael, I'm just using you as an example because you had yours in there. I actually created this based on mine, but then played around with it and made sure all the assumptions work for different size funds. And then you're going to have, as a part of your fund revenue, you're going to have these one-time expenses or one-time fees. So debt placement, acquisition, disposition. So those are going to come into play primarily in the first 2 years. Over the first 2 years. So, you kind of see that your revenue increases from year 1 to 2. And then from 2 to 3, it kind of decreases because you don't have these one-time, revenue drivers. And then you kind of jump back up in the last year because you have, one-time disposition fee. So you can kind of see how your fund revenue isn't a straight line if you're using these assumptions. And I think that's kind of what Dr. Tony and Raj are kind of talking about a little while ago in the last call on Wednesday, right? You need to really kind of know what your fund projections are going to be per year. I think a lot of people are going into this or could be going into it like, hey, a fund's just going to make a lot of money, but what is it really going to make? And so you're, putting together something like this is helpful. Your operating expenses, I feel like these are always going to be different for folks. I think generally insurance, legal, dues, and subscriptions, rent, personnel, generally are, things that you're always going to have. I added other yellow here, yellow boxes. You can put in other things, potentially marketing, admin. You could have licensing or something. I don't know. You could have, but it's up to you what your operating expenses are. Insurance, 3,500, legal. Maybe legal is actually 20,000 this year, and maybe that's kind of outside of the purview of the fundraise. Dues and subscriptions could be anything on the computer. If we have an investor management software, that's probably what it's going to cost. Maybe your rent is 30,000, so you can change all that here. this is going to grow by, the operating expenses are going to grow by 5% per year. Your personnel is going to grow by 10. That's just, pretty safe assumptions on the operating expense side. So you kind of, I think this is going to be the biggest driver in most people's operating expense columns. What are you going to pay your personnel? And then you can kind of see here, a smaller fund doesn't necessarily, can't really, it makes a lot of sense for like one person in this fund because of the size. Not saying that a $2.5 million fund won't yield more revenue. This is just based off of net asset value. If we have other revenue drivers in there, this revenue number is going to increase and your operating income is going to increase. But overall, let's see, this shouldn't be here because you're selling in year 4. So overall, like this, for example, is primarily break even. Or it's going to lose 84,000 based on these assumptions. So on this, let's jack the asset management fee up to 4%. Okay, that looks good. If you're running a $2.5 million fund, you can increase your net asset value management fee by 4%, and you're making money every year. And that's a pretty handsome sum to be making. This is your operating expense margin, just to see kind of what you're operating at. I don't know. Tony and Raj might have to chime in to see what we're actually supposed to be operating at on the fund side, assuming, these basic fund revenue drivers and the operating expenses. But created this for you guys all to kind of play around with. So I'm going to put another kind of fund size in there. Estimate number of 3 transactions, fund term 5, target IRR of 20%. We'll do 2% across the board here. So you're playing around with all those different assumptions. These are going to be, operating expenses are going to be different for everybody, right? This seems pretty high. Let's see. You can see if you have too low of a management fee, for example, here on this fund, let's make it 5. On a $5 million fund, you have a 1% management fee here on the net asset value, regardless of what, because you have, because you have such high personnel, this is not even really a profitable fund. So if your personnel is going to be 300,000, you're going to want to play around with, the management driver here. So you kind of get to break even. Oh, there's a little bit of profit there, 454,000. If your net asset management fee is 2.5%. All right, well, I'm going to kick this over to you guys in the group. You guys can play around with it. Hopefully this kind of gives you a little bit more insight on where you need to be pricing certain things. And I'll fix a few of these things before I send it to you. Thank you.